Welcome to video 4 of part 3 of the EA Tax Training free EA exam prep course for 2025. Tom here, back with you to discuss the tax filing process. This is the final video in part 3 and in the entire course. It's also the shortest video. Congratulations on making it this far, and let's see what we are going to learn today. Specifically, what we will be talking about is tax return accuracy, record maintenance, and then we will spend the bulk of our time discussing electronic filing. Our free resources from irs.gov. The first two you'll recognize from the previous videos in part 3. Then we've added two new forms here in their instructions, Form 8879 and 8453. The good news is they are both short forms and short instructions, but you will want to get those and read through those for the exam. Our first topic then in this video is tax return accuracy, and we'll start by talking about reliance on tax software. The taxpayer is responsible for the amounts reported on their return regardless of the method of preparation. So notice there, who is responsible? The taxpayer, not the tax return preparer. Of course, we want to do a great job for our clients, and we could be held civilly liable if we make a mistake. In other words, our clients could sue us. But as far as the IRS is concerned, ultimately, it is the taxpayer who is responsible for what is on their tax return. When you are using tax software, and of course, we're all going to use it, it's very valuable, but it should not be exclusively relied upon to accurately report all of the amounts on your return. These tax software programs can get it wrong. I've seen it many times. Now they're getting better and better, and usually where they're going to get things wrong is on the more obscure and unique type of situations. It's not the everyday normal things that you see in almost every tax return, but you may have some sort of niche situation that doesn't come up very often, and the software just doesn't quite get it right. But in any case, regardless, you are always going to want to check to make sure that the numbers you expect to see on the return are the numbers that are on the return. You can't just put some numbers in to the software, assume that it does it right, and file that return. That's why we can't have just data entry people doing tax returns. You have to have somebody who understands taxes and who understands the process. There have been taxpayers who've gone to court and said, hey, I put it in the software. I was relying on the software to get it right. It was wrong. And the tax court said, tough. That is not a valid defense. It's the software's fault defense does not fly with the courts. It does not fly with the IRS. And of course, anytime you're dealing with computers, you've got this old idea of GIGO, garbage in, garbage out. Doesn't matter how good the software is, if you're putting in bad information, you're going to get an inaccurate output from that software. No matter how hard we try, there are mistakes that are going to happen. Sometimes the taxpayer or even the preparer is going to miscalculate an amount on the return. They're going to put in a wrong dollar amount into the software. They're going to duplicate an entry somewhere. This does happen. Duplicate entries especially are common, and ironically, they are common because the software is trying to be efficient and to help you. And if you don't realize that, it's easy to put the same amounts in twice. So for example, if you have a client who is making HSA contributions, health savings account contributions through work, and maybe their employer is also making contributions, that is going to be reported on their W-2. So if you go into the software, put in all the amounts from the W-2, then you go to the separate HSA screen, and you then put in the amounts again that your client contributed to that HSA, you're going to have a duplicate. So that's the type of thing you have to look out for. Same thing can happen with state taxes. You get a 1099-G from your state saying that you got a tax refund for the year. If you use the same software last year, it's going to know that you got a state tax refund, and so it's going to automatically include it. But if you go to the separate screen, enter it again, you could double count it. And then on Schedule C, you get 1099s. most likely the taxpayer has already included all of the income in their books and records, including the amounts on the 1099s. So if you input the 1099 separately, like the 1099 NECs, and you put the revenue that the client reports to you from their books and records, it's likely you will be duplicating that. So these are just a few examples of the types of things that can be duplicated. So especially when you are getting forms, 1099s, W-2s, you want to make sure that the software isn't already picking that up and then you are separately putting those amounts in. You want to make sure that you only enter those amounts one time. If you do make an error, any type of error, after filing, and you realize it before the IRS points it out for you, then you would likely want to file an amended return. Again, you need to go to your client, explain what happened. They are the ones who are going to decide whether or not to amend the return, but it's likely that it's going to be a good idea to make that amendment. If the IRS notices the error first, then they will send the taxpayer a notice. And the notice might just say, we noticed this mistake, we corrected it, here are your corrected amounts, there's nothing else for you to do. Or they might say, we noticed the mistake, here it is, and you owe more money, please send it in, or we owe you money, so you're going to be getting a check. Or the notice could say, we're not exactly sure how this affects your tax return, so you need to amend your tax return. So you just get that notice, read it, and follow what it says. If you don't agree with it, of course, then you will want to respond, as we discussed in a prior video. And then if you do agree with it, take whatever steps are mentioned in the letter. Our next topic is record maintenance. Record retention for enrolled agents. Of course, as part of the process of preparing the return, you are going to be requesting and getting documentation from your client. And then you are going to want to keep copies of those things. Usually they're going to be electronic copies. They don't have to be, but usually that's what we do. So you're going to be getting all these normal types of things: prior year tax returns, W-2s, 1099s, financial and legal documents, expense records and receipts, business entity documents such as partnership agreements, et cetera, and so forth. You will want to keep copies of all of those things. You should also keep notes from any client meetings, including questions that were asked and answers that were given, any relevant emails or other electronic exchanges with the client. One thing I like to do is if I have a conversation with a client, I will then summarize it in an email. Here's what we discussed. Here's the steps we're going to take, and send that to them so that they can respond and either say, okay, I agree, or no, I understood it to be this. And you can have that record going back and forth. And then you can keep a copy of that in your files. Now, you do have to be careful. Some things you don't want to put in writing. So, for example, if there's a possibility of a crime being committed, you don't want to be putting that type of information into an email. You want to get them in touch with an attorney, and then they can handle that on their end. Or if there's very sensitive information in the email, then you probably want to send it as encrypted, which we will talk about a little bit more later. But still, in general, your normal everyday type of conversations, it is good to memorialize those in writing so that there's no misunderstandings and so that you have a copy of that in the future. If a question comes up about it, you can look back, refresh your memory, and say, oh, yeah, that's right. We talked about this, and here's why we did what we did. Again, paper copies are fine. It's just a lot easier, more efficient, and cheaper these days to keep it electronically. And there are various types of software out there that you can use to help you to store all of this data. How long should you keep records? Well, the short answer is the records must be kept for as long as the statute of limitations is in effect for that tax return. Usually, of course, that's the 3 years from later of when the return was filed or when it was due. Remember, that's the statute of limitations that the IRS has to go back and assess tax, but there were those exceptions where it could be longer. For property records, as we've discussed before, you need to keep those records until the statute is expired on the year that the property was disposed of. So you could have a building, for example, that you keep for decades, and then you need to keep those records for those decades plus another 3+ years after that property is disposed of. So those will be long-term type of storage items. Payroll and employment tax records have their own records maintenance requirement. They should be kept for at least 4 years after filing the fourth quarter of that particular year. So all of the information you see on the screen, the names, addresses, etc., of your employees, the amounts and dates that they were paid, copies of W-2s, employment tax returns, etc., and so forth, anything payroll and employment tax related. Remember that for the exam, 4 years after filing the fourth quarter of that year. Data security, we talked about this somewhat before, but protecting taxpayer data is required by law and it is enforced by the Federal Trade Commission, or FTC. Tax preparers must have a written information security plan, or WISP, which should do all of these things: designate someone to coordinate the program, identify and assess the risks of the current program and the effectiveness of it, design and implement a safeguards program, and then monitor and test it. So it's not just something you write up and put in a drawer. It needs to be regularly monitored and tested. Select service providers that can maintain appropriate safeguards. So if you're choosing software, for example, especially if it's in the cloud, you want to make sure they have got all the data protection safeguards in place, and then you want to evaluate and adjust your program as necessary. So as things change, as threats change, as hackers get smarter, you are going to need to adjust accordingly. Basic security steps you'll want to take: learn to recognize those phishing emails that we talked about and avoid them. Of course, never click on a suspicious link. Install anti-malware and antivirus software. Use strong passwords at all your sites and use different passwords at different sites so that if somebody steals your password from one site, they can't then go to all the other sites where you have an account and also get into those. Encrypt all sensitive files and emails. So most email programs will have a way to encrypt the message. Sometimes you just have to put the word encrypt in the subject line and it will automatically do it. So it will make it digitally very difficult for anybody who might intercept that email as it goes through the ether to actually read the contents of that email. So if you've got any sensitive taxpayer client information, you want to encrypt those emails. Back up all sensitive data to a secure outside source. Of course, this is very important. It's great to have a cloud backup if you can, but you might also, or instead, want to have your own backup, such as on an outside hard drive. So it's a hard drive you can plug into your computer, back up everything you want to back up, and then unplug it from your computer. You want to make sure you unplug it from your computer, because if somebody hacks into your computer, anything that's attached to it, they'll be able to get to. So back it up regularly to that external hard drive, then unplug the external hard drive until the next time you want to do the backup. And then make a final review of all tax return information, especially bank account information, before filing. So of course, again, we want to minimize mistakes. So that's one reason we're always going to be checking that return, checking back to the source documents, making sure it's right. And in particular with the banking information. So if you're getting a direct deposit refund, you're going to have the bank routing number and account number on that return. You want to double, triple, quadruple check. Make sure you have the right numbers because you don't want that refund going to somebody else's bank account. If you're getting a new computer and disposing of an old one, then you want to make sure that you wipe clean or destroy the old computer hard drives, and that also applies to printers that might be storing data. You want to limit access to taxpayer data to individuals who need to know. So if you've got, for instance, an administrative person in your office who doesn't actually need to see the taxpayer data, then they should not have access to see that data. You want to check e-file applications and PTIN accounts weekly for total returns filed using eFINs and PTINs, and deactivate any unused eFINs. So an eFIN, we're going to talk about it here in a few minutes, but it's an electronic filing identification number. You can actually go to the IRS website and see how many tax returns have been filed using your PTIN and using your eFIN. It's a good idea to go in there periodically and monitor that to make sure someone has not gotten hold of your numbers and is then filing false tax returns using your ID number. And then you want to withdraw from any power of attorneys for taxpayers who are no longer your clients. So they were your client, you got a POA. If they're not your client anymore, withdraw. Remember, you just take the front page of that 2848, you write withdraw on it, you sign it, you date it, you send it in. That way, no one can accuse you of doing anything with the IRS that you should not have done. And there's no way anybody from your office could get in there and pretend to be you or anything like that and cause a problem with taxpayer data. So withdraw from those that you no longer need to have active. If you do have a breach, then you need to report it immediately to the IRS stakeholder liaison. You will want to remember that for the exam. The IRS stakeholder liaison, there are several of these throughout the United States. You may also, of course, want to report it to law enforcement, either local or federal law enforcement. Not a fun thing to go through, but if it happens, you need to face it, report it to who you need to report it to, take whatever steps you can to minimize the impact, make sure everybody who's affected knows about it, and then tighten up your security to make sure it doesn't happen again. If you have paper files and documents, those also need to be kept secure. So you want to keep those locked up. You want to have a room or a cabinet that's protected against things like fire and flood, etc. And then once it's time to dispose of the documents, do so by shredding them. Get a good cross-cut shredder, or if you got a lot of documents, you might want to hire a service. You can have a locked box that you put documents into. Then the company comes by on occasion, picks those up, and then they shred them. But you want to have some system in place for managing those paper documents. Now let's move on to electronic filing. As a tax practitioner, you can apply to become an authorized e-file provider. And if you are going to be working for yourself, of course, you are going to be electronically filing tax returns. So you are going to want to be an authorized e-file provider. In order to do that, first, you have to have an e-services account with the IRS. It's at irs.gov/e-services. Then you fill out the online application, and you are going to want to select the one that says ERO, which is Electronic Return Originator. Make sure you know that for the exam. It will come up, ERO, Electronic Return Originator. In order to get this, you're going to have to pass a suitability check, which may include a credit check, a tax compliance check, a criminal background check, and a check for any prior non-compliance with e-file requirements. The process to get approved can take up to 45 days. Once you are accepted, you will be issued an EFIN, that electronic filing identification number. Usually you are going to get one EFIN per firm, per location. So if it's just you, you'll have one EFIN. If you've got multiple offices, then each office will get its own separate EFIN. So that way, when a return is submitted, the IRS will know which location it came from. E-file mandates. Any tax preparer who reasonably expects to file 11 or more tax returns in a calendar year is required to e-file. Now, there can be exceptions for special circumstances, but you have to apply for a waiver from the IRS in order to not have to e-file those returns. You file for that waiver by filing this Form 8944. If that is approved, then every time you submit a paper tax return, you have to include a copy of this Form 8948, which explains why you are not electronically filing, so that way the IRS knows not to come after you for not following the e-file mandate. As we stated in part 2, anyone who files 10 or more information returns, the W-2s, 1099s, must file them electronically. It used to be 250 or more, but starting with the 2023 tax year, it went down to 10, and that's total. So if you've got 3 W-2s and 7 1099s, that is 10 information returns. You must file them electronically. So the electronic return originator, what's it all about? An ERO is the authorized IRS e-file provider that begins the process of the electronic submission of a tax return to the IRS. They are usually the first point of contact for most taxpayers who are filing a return using IRS e-file. The ERO must begin the electronic submission of only returns that they either prepared themselves or collected from a taxpayer or from another provider. So usually you're just going to be e-filing returns that you prepared. It is possible, however, to e-file returns for taxpayers who prepare their own tax returns or for other tax preparers who, for some reason, are not EROs themselves. In practice, I have never done that. I have only filed returns for my own clients. But for the exam, you want to know that it is possible to also file those returns for other preparers or for clients who prepare their own returns. What you do not want to do is file a return for someone that you just don't know. Somebody that emails you and says, "Hey, can you file this for me?" Somebody who walks in off the street says, "Hey, I want you to file this for me." I would be very leery of doing that. You need to make sure that the person you are filing for, that you know them, that you trust them, and that you are not being scammed. So that's why I say, as a practical matter, you're probably never going to do this. It's not something you're really going to want to get involved in. But for the exam, just know that it is possible to do it. And remember, being an ERO is a separate and distinct function from being a preparer, even though many firms are both. But that's why it's important to understand, why could I submit a return for somebody that I didn't prepare the return? It's because you are acting as an ERO in that instance, not as a tax return preparer, because they are two separate and distinct things, even though most of us do both and we kind of think of it as being one and the same. It really is separate. An ERO begins the electronic submission by doing one of the following. Either they electronically send the return to something called a transmitter that will then transmit the return to the IRS, or they provide the return to an intermediate service provider who then processes it and submits it to the IRS, or you could directly submit it to the IRS. Again, what we do in the real world is we've got tax software. We submit it through the software. The tax software company will either be a transmitter or an intermediate service provider themselves, or they will contract with one, and then it will get submitted to the IRS. But again, for the exam, you need to know that this is who you can send it to: a transmitter, an intermediate service provider, or in some cases directly to the Internal Revenue Service. As an ERO, you have a variety of responsibilities, including timely origination of electronic returns, submitting any required supporting paper documents to the IRS. We'll talk a little bit more about that. Providing copies to taxpayers of their return, retaining records and making records available to the IRS, accepting returns only from taxpayers and other providers, reporting income derived from electronic filing activities properly, protecting your EFIN. It must be safeguarded and not sold, traded, rented, transferred, or gifted. You need to treat it like your Social Security number. Don't give it out to anybody who doesn't absolutely need to have it. Even if you sell your firm, you don't sell your EFIN. The buyer has to get their own EFIN from the IRS. So that EFIN is going to be particular to you and to your firm. E-file authorization. A taxpayer must sign a Form 8879 when you e-file a return for them. This is the taxpayer's declaration that the return is complete and accurate, and it gives you the authorization to electronically file the return. So, of course, if you are filing a return on paper, there's the signature block, and then the taxpayer signs and dates at that signature block. But obviously, when you are e-filing, there is no place for them to physically sign. So what you are going to do is give them this Form 8879. That is going to do a couple of things. First of all, it's going to be them saying, yes, this tax return is complete and accurate under penalties of perjury, just like if they sign the return. And it's going to say, I give this ERO permission to e-file my tax return. So let's look real quick at a copy of the 8879. Basic information at the top. It's going to have a couple of key numbers here from the tax return. Of course, your software is going to fill that in. Then this is their declaration and signature authorization. Then they're going to sign it. As part of every transmission, the way they are quote unquote signing the return is with a PIN number. This is different than the security PIN that they get if their social security number gets compromised. This is a different type of PIN, but it is a PIN that your software will actually generate. And by signing this, they're saying, okay, it's fine to use this PIN as my signature. If the taxpayer actually wants to pick their own PIN, there is a process for doing that, and they would check this other box. In practice, nobody wants to do that. Just let the software generate the PIN and they sign this form. If it's married filing jointly, then the spouse would sign and date. And then the bottom part is just for the people who want to select their own PIN. Paper document transmittal. There are certain paper forms and documents that are required to be filed along with electronic returns in certain circumstances. If you have any of those, then you as the ERO have to send those along in the mail to the IRS, and you transmit them with this form 8453. The items that may be transmitted with the 8453 are listed on the form itself. We're going to look at it here in a minute. They must be submitted within 3 business days after IRS acknowledgement of acceptance of the e-filed return. And if a paper document is required other than one that is listed on the 8453, then you cannot e-file that tax return. You have to paper file that return. So here is that 8453. Basic information at the top, and then it's just a list of all the different forms. So you'll recognize a couple of them. Here's the 2848 power of attorney, the 3115 application for change in accounting method, and you can see the rest of them listed here. And then you can see at the bottom, you don't actually have to sign this form. It's just a transmittal form. Whatever form you are sending with it will require a signature, but the 8453 itself does not need to be signed. Rejected returns. So if you go to submit a return, hopefully it goes through, you get an acknowledgement back that it's been accepted and it's been filed and everything is good. But sometimes that is not going to happen. It is going to be rejected. When it is rejected, it's usually going to be due to a mismatch with information that the IRS already has. So for instance, social security number and date of birth. The IRS cross matches what you put on the return with the records held by the Social Security Administration. So if something doesn't jibe, it is going to reject that return. Or, as we discussed previously, if a tax return has already been filed with the taxpayer's Social Security number, it's going to be rejected. If a listed dependent has already been claimed on another return, so sometimes you got both parents, for instance, trying to claim a child as their dependent. Whichever one files first, it's going to go through. The parent who files second, it's going to be rejected. You could also have an electronic signature mismatch. So either if there is an identity protection PIN required and it doesn't have it, or another way that the IRS tries to ensure that the person filing the return is in fact the taxpayer, is they will say, what was your adjusted gross income last year? So when you go through on your tax software, that's going to be one of the questions. They're going to say, what was last year's adjusted gross income? You put that in. That helps the IRS to match up that return to make sure it's a good return. Well, if that doesn't match, then it will be rejected. And then if you've got an EIN, an employer identification number, doesn't match the IRS records, that too will be rejected. If you have these situations, everyone can be very different. You're going to have to contact the client and then work to resolve it. So for instance, if you got that situation with the parents and one parent claims the child as a dependent, now your client is trying to claim the child as a dependent, gets rejected, you're going to have to figure out what to do. If you go through the situation and it seems like your client really does meet all the criteria to claim that child as a dependent, then you'll talk to the client. And then what you're probably going to have to do is file that return on paper. Then I would attach a statement saying, taxpayer is claiming this person as a dependent, they meet all the criteria, etc., and then let the IRS figure out who's actually entitled to that dependency exemption. And then all of these other situations, you're just going to have to handle them as they come up, do the best you can, take whatever steps you can take in order to get it resolved. Identity protection PIN, we did talk about this previously. It's a 6-digit number that prevents someone else from filing a tax return using your Social Security number. If you are a confirmed victim of tax-related identity theft, the IRS will automatically send you a new PIN every year. They send it in the mail, but anyone can apply for an IP PIN to proactively prevent tax-related identity theft. You can apply online, by mail with this Form 15227, or in person at a local IRS office. No matter how you do it, though, you are going to have to verify your identity. Record keeping requirements. As an ERO, you must keep copies of the following until the end of the calendar year in which the return was filed. So it was a 2024 return filed in 2025. You have to keep these things at least until the end of that calendar year. Now remember, this is the ERO requirements. As a tax preparer, you are going to want to keep these things for a longer period of time until the statute of limitations has expired. But remember, ERO, tax preparer, two different things, two different functions. So for the exam, you will want to be able to distinguish the ERO record retention requirements. So these are the things that need to be kept until the end of the calendar year in which the return was filed. Copies of any forms, W-2, W-2G, 1099-R, copy of that 8453 along with any paper documents that were transmitted, acknowledgement files for IRS accepted returns. So when the return is accepted by the IRS, you will get an acknowledgement back. So you need to keep those files. A complete copy of the electronic portion of any return that can be readily and accurately converted into an electronic transmission that the IRS can process. So if the IRS asks you to submit the return again, you need to be able to do so. And then a copy of signed IRS e-file consent to disclosure if you meet either of these that is seen on the screen, if the taxpayer selected their own PIN, or if a 4868 is filed without electronic funds withdrawal. An ERO must keep copies of the signed Forms 8878 and 8879 for 3 years from the due date of the return or the date the IRS received it, whichever is later. So that's their authorization to e-file and their statement that yes, the tax return is in fact true. Have to keep that for the statute of limitations, the later of 3 years from when the return was filed or was due. E-file advertising standards. IRS e-file is a brand name. EROs are authorized e-file providers and can represent themselves as such. You must follow the advertising and solicitation provisions of Circular 230, so no false, deceptive, or misleading advertisements, etc. If offering a refund anticipation loan, the advertising must be clear and easily readable and must state that the taxpayer is borrowing from a financial institution against an anticipated refund. So a refund anticipation loan, you may have seen these advertised by tax preparers. They say, get your refund immediately. So what you are offering the taxpayer is actually a loan from a bank. Probably your tax software will have a system that you can sign up to offer these if you want to. So the taxpayer comes in, you prepare their return, they have a refund. They can walk out that day with a refund minus a fee, but they're not actually getting their refund at that point. What they are getting is a loan in anticipation of them getting a refund. If for some reason they don't actually get the refund, then they are going to have to pay that amount back. So the taxpayer has to know that they are borrowing money from a bank and that they are going to have to pay that money back if that refund does not, in fact, come through. So the advertising has to be clear on that. You can use the IRS e-file logo, but do not combine it with the IRS eagle, the word federal, or any other words or symbols that imply a special relationship with the IRS. And you cannot place other text on or near that logo, and it must meet other standards. So you want to make sure that you are following all of the advertising standards when you are advertising yourself as an e-file provider. Compliance requirements. The IRS monitors providers for compliance with all of these requirements as an ERO. The IRS performs suitability checks on the firm and its principals and responsible officials upon admission to the e-file program and at regular intervals thereafter. Failing the check may result in revocation or sanction. So when you first sign up to be an ERO, they're going to do those checks and then on a regular basis thereafter. So if later on you have some sort of problem that comes up, a criminal conviction or something like that, you could get your ERO revoked. The IRS monitors providers through review of IRS records and during visits to providers' offices. So they can actually come to your office, ask to see your records, watch your processes, etc., and so forth. When they do their monitoring, they're going to be looking at all of these types of things, reviewing the quality of submissions for rejects and other defects. So if you have a higher rate of rejected e-file returns than other firms do, they might think there's some sort of quality problem there, and they're going to want to look more closely. Checking adherence to signature requirements on returns, so making sure everything that's supposed to be signed is being signed. Scrutinizing advertising material, examining records, observing the office and security procedures, checking tax compliance on the firm and its principals, monitoring compliance with tax preparer regulations, especially due diligence requirements for all of those credits and for head of household status. So the IRS wants to make sure that if you are an ERO, that you are following the rules, getting all the signatures you're supposed to get, keeping your data safe, doing your due diligence, etc., and so forth. Revocation. The IRS may revoke participation of a firm, principal, or responsible official in IRS e-file if either a federal court order enjoins them from filing returns, or if they are prohibited by a federal or state legal action that would prohibit participation. If you are revoked for this reason, you are not entitled to an administrative review process. There's no appeal, it just happens. If that injunction or other legal action expires or is later reversed, then you may reapply for the program. Sanctioning. Violations of IRS e-file requirements may result in a warning or a sanctioning. Depending on the seriousness of the violation, the sanctioning may be a written reprimand, a suspension from the program, or expulsion from participation in the program. The seriousness of the violation depends on whether it is a level 1, 2, or 3 infraction. So you will want to know these for the exam. These are the level 1, 2, and 3 definitions. Level 1 infractions, minor violations with little or no adverse impact on the quality of electronically filed returns or IRS e-file. This usually results in a written warning. Level 2, violations that have an adverse impact on the quality of electronically filed returns or IRS e-file. This includes continued level 1 infractions after getting a warning. So if you have a level 1 infraction, not that big of a deal, but if they warn you and then you keep doing it over and over again, that itself can become a level 2 infraction. And a level 2 infraction usually results in a 1 to 2 year suspension. And then level 3 means serious violations, including continued level 2 infractions. This results in a suspension of 2 years from the e-file program, or for very serious violations such as identity theft, fraud, or criminal misconduct, immediate expulsion without the opportunity for future participation. Appeals. If a provider is suspended or expelled from the program, they can request an administrative review with the office that sanctioned them. You cannot get a review if it's a written warning. It has to be a suspension or being expelled. If that review upholds the sanction, then the provider can appeal to the IRS's Office of Appeals, as we have discussed previously. An individual who is expelled from the program may be able to reapply after 5 years, but some expulsion situations are not going to be eligible. So the most serious ones, they're never going to let you back in the program again. And that, my friends, is the end of video 4, the end of part 3, and the end of the entire course. Congratulations on making it through the course. Best of luck to you on the exams. Go back and watch any of the videos where you need a refresher, study the slides, and then come back and comment on any of these videos and let me know that you passed. I would love to be able to celebrate your success with you. And also, stay tuned to this YouTube channel as there will be ongoing education and updates to help you throughout your career. Thanks for joining me, and best wishes to you on a successful exam and a successful tax career.